Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady, where I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to hear about topics that are important to the home business community. All right. So I want to talk about 401k withdrawals. This is something that I actually encountered a couple times during the tax season of, people having to bear the consequences of a 401k withdrawal. So I want to talk about that because with your 401ks, here's the overall message. And I wish somebody had said this to me like 20 years ago. Okay. Your 401k is not a piggy bank. It is not a piggy bank. It is not an ATM. We're talking about saving up for your future if you may be unable to work or if you don't want to work or whatever. That is what your 401k is for. It's not a piggy bank. And you know what? And I've been through some of this stuff myself. And so that's why I said I wish somebody had told me this 20 years ago, because if I had known that, I'd have done some different stuff. Okay. So with your 401k, if you are younger than 59 and a half, then you will incur a penalty from withdrawing from your 401k. Your 401k, you contribute to that with pre-tax dollars. Okay. I'm not talking about a Roth IRA. I'm talking about a traditional 401k IRA. You're contributing to that with pre-tax dollars. All right. And so there is a penalty if you withdraw from that before you're 59 and a half. There's a 10% penalty. So and also I want to make sure that you understand that there is a difference between the penalty and the taxes, because that's where a lot of people get confused. So again, if you are younger than 59 and a half and you withdraw from your 401k, you're going to pay a 10% penalty, but you're also going to pay taxes on that money. So depending on how much you made in other areas, you could be creating a tax bill. It will definitely put you in a different tax bracket. So what happens is, sometimes people will take the withdrawal from their 401k and have taxes withheld, but really don't withhold enough because they think, okay, well, I'll withhold enough to cover this penalty, but it doesn't cover the income tax part of it. So for instance, you may, have, withdrawn $70,000 and withheld $10,000 in taxes and get $60,000 that's given to you. Okay. You're going to get taxed. That $70,000 is what's going to get added to your income. You'll get credit for that $10,000, but you're going to get a $7,000 penalty because that's how much you withdrew. It's not how much you actually received, but how much actually came out of your account. So you're going to get that $7,000 penalty for taking that out before 59 and a half. Now, there are some exemptions to the penalty. There are exemptions to the penalty, not to the tax part. Okay. So there are a couple of exemptions. Number one is the rollover. That means you take it out of one retirement account and put it into another qualified retirement account, and it has to be done within 60 days. So if you've taken money out, from the clock starts ticking. So if your plan is to really roll over your money into another qualified account, you want to make sure you open up that account first and then facilitate the rollover. Don't just take the money out and then you hold on to it and then, because sometimes it gets good in your hands. Okay. Number two, medical expenses. Now, for medical expenses, again, what's deductible is anything that's over 10% of your adjusted gross income. Okay. That part is deductible, but if you take a distribution for medical expenses and then you don't take a medical expense deduction, see, the IRS does check these things to verify that you're actually using this money the way that you're supposed to. So you can't just say it's for medical expenses and then you don't have a medical expense deduction on your taxes. That don't make no sense. Okay. Health insurance premiums. And it says withdrawals from IRAs used to pay health insurance premiums while unemployed are exempt from this 10% penalty, but there are some rules that go along with that. Higher education expenses. And But the distribution cannot exceed the qualified higher education expenses incurred during the tax year. So that is, tuition, room and board, fees, books, supplies. So if you got $30,000 worth of tuition expenses and then you go take out 50, no, you only the penalty you are exempt from the penalty for the amount of the qualified higher education fees. This is the one that really gets people, is the first time home buyers. Now, you can take money out if you're a first time home buyer, but the penalty is anything over $10,000. So you can take out up to $10,000 and there's no penalty. Anything over that, you're going to get penalized. So if you take out, $90,000 to buy a house, then only, 80,000, you'll have an $8,000 penalty because that first 10,000 would be penalty free. So that's the thing for first time home buyers. A lot of people don't know that. They just hear that you can take out money if you qualify to be a first time home buyer, and they just go take the money out and don't understand the $10,000 limitation. What is another one? Oh, there are some other ones like for distributions made to beneficiaries in the event of disability. Now, for disability, you have to be a qualified disabled person. That's not something that you say. It's something that you have to prove. Okay. So that, is like a substantial documentation from your physicians and all of that. Okay. But, the thing that, a lot of people do, we take out money out of our 401k to go pay off bills. Some people take money out of their 401k to travel. Okay. But these don't, and here's another one that really, it irked me to my entire soul, is that during the government shutdown, there were people that had to go into their 401ks in order to live. And guess what? It's not penalty free. That's one of the things that really grinded my gears during the tax season, because there were those people that, when the government shut down, they weren't getting any paychecks. People still had to live. And so they dipped into their 401k. So not only did they have to pay taxes on that money, they also had to pay penalties if they were younger than 59 and a half, which stunk to me. The other thing I want you to keep in mind is that when you're making these withdrawals from your 401k, the companies are not looking at your entire picture. You call them and say, I want my money. They say, okay, cool. They're not looking at any other type of income that you have. They're not looking at, the consequences. They're just going to tell you their part. And it's important. This is why it's really important for you to consult with people beforehand, so you can really understand what the ramifications are going to be. If you have Social Security and then you take out of your 401k, that additional income, even if you don't receive a penalty, that additional income can then make more of your Social Security income taxable. So you're creating a tax bill that way. It's a mess. So the companies take no responsibility to ask you what you're doing with your money. They're expecting, you to know, because it's your money. It's really not their place to advise you as to what's going to happen when you take this money out, other than the 10% penalty if you're under age 59 and a half. They're not asking you why you're taking your money out. They're just saying, all right, we'll withhold X amount for taxes, but they don't have the rest of your tax picture. So this is why it's important for you to have someone to call before you make these decisions, taking your money out of your 401k. Again, I wish I had known that. Okay. Because I lost a lot of money doing that. And, but when you know better, you do better. And so this is why I'm having this conversation, because yet and still there are people there, and we're not even talking about young people. We're talking about people who are up in age, when you're getting into and I don't mean to sound like you about to, 1 foot in the grave, but when you're talking about being 55 years old, and then your taxes hit different when you're in your 50s and 60s, because you don't have 9 times out of 10, your kids are grown and your home is pretty much being close to being paid off. So you don't really have interest in taxes that you can deduct, and you're itemizing. And with the tax code change, a lot more people are itemizing anyway. So when you hit, in your 50s and whatnot, you really don't have tax deductions, okay, and tax credits and whatnot. That's generally not it. By that time, your kids are usually grown. They're out of, you paid for their college. And so all of those deductions are gone. So yeah, that additional income hits different when you don't have itemized deductions that you can take to lower your tax bill. So this is why it's important to consult with someone before you make the move. After you make the move, there's really nothing we can do, especially if you have exceeded any type of deadline. So yeah, that's the scoop on the 401ks, you guys. Like I said, it's, if you're making an informed decision, that's one thing versus being caught at tax time with a huge surprise. I'm all about making informed decisions. You might consciously accept, okay, I'm going to pay this penalty. I'm going to pay these additional taxes, and you have something else in mind for your money. Hey, if you are making that conscious, educated decision, more power to you. But it's the ignorance that costs. Ignorance costs, because if you don't plan for those additional taxes, if you don't plan for that penalty, and then come tax time, now all of a sudden you got a tax bill and you've got no money to pay it. That's no way to be. No way to live. And especially when we're talking about being 50s and 60s and you're headed into retirement years and you're dealing with tax debt. Absolutely bananas. All right. So that's it for today, you guys. I hope this gives you something to chew on. If you're considering taking money out of your retirement account, consult with an enrolled agent, consult with the CPA so that you understand how it's going to impact your tax situation. Everybody is different. All right. So thank you guys so much for tuning into Home Biz Tax Talk. Again, we air Monday through Friday, 9 o'clock-ish, and you can come right here to get your questions answered about your home business taxes. All right. Have a great day, and I'll see y'all next time. Bye.